market today is also the global picture. Now Moody's has downgraded the US credit ratings, which could see a little bit of impact on the stock market. Let's bring in my colleague Hersh to give us more comprehensive details on the events that led to this downgrade and what it could mean for the markets.
Well, let me first start off with the reasons for the downgrade, because that's the big one, right? Moody's was the only rating agency which hadn't downgraded US debt. They now have. From a AAA negative, they've downgraded to a AA1 stable. What they've said is that there has been significant expansion in US debt over the last decade or so. 6.4% was the FY24 fiscal deficit. That has gone up now and is expected to continue to rise. It's expected to go to the 9% number by 2035, which is quite strong in that sense. But what is one critical point of concern for them is roughly 78% of the spend at that 9% fiscal deficit to GDP will likely be fixed payments. Those will be interest payments and entitlement payments. Entitlement payments will rise. Mind you, there are committed payments which the US has made in terms of Medicare, etc., which will continue to flow through even at the higher levels. GDP is not expected to rise in a sharp fashion. It's largely expected to be flat, and therefore the increase in expenditure will very quickly add to the fiscal deficit overall. The foreign fiscal deficit, or the foreign holding of the deficit of the US, is currently sub 100%. It's expected to be at 134% in the next 5 to 10 years odd. And therefore, Moody's clearly not positive with regard to how that is playing out. Some of those numbers not adding up for the moment, and therefore you're seeing that sharp downgrade by Moody's. Of course, we've had downgrades in the past. This is a bit of a delayed downgrade by Moody's, and therefore you'll have to wait and watch what the reaction actually is.
Okay.